taking an unconventional look at stocks, property, bonds, economics, and more. This is the Total Money Management Podcast with Steve Moriarty, Tom Hill, and Jacob Senior.
All right, welcome back to the Total Money Management Podcast. In this episode, we're going to be reviewing the week of February 12 to 16. As usual, here with Jacob Senior and Steve Moriarty. How are we going, gentlemen?
Excellent. Yeah,
Good
getting
stuff.
there. It's been a good week, actually. Long. But,
Do you want to drop a few names, mate? Go to any football,
All right.
Go to any football openers during the week.
I've been hanging around with the Broncos, but that's all you're getting.
That's it.
That's all you're getting.
Names. We want
You're not
names.
Rubbing shoulders with giants.
I'm not taking the piss this week. It was the tennis last week.
Yeah.
Tennis last
Now
week.
it's the Broncos.
Must be nice.
And
Been
you
in
only
any-
took the Broncos because you couldn't get your private jet over to Taylor and what's his name? Who's the guy who Taylor Swift goes out with who plays footy? NFL.
I don't follow it.
Oh,
Did you watch-
seriously,
did you
you
watch
guys don't.
the,
Kelsey.
No, I'm not a fan of American football.
Oh, mate.
Sounds like you know.
Yeah.
wanna fill
No.
us in?
I don't understand it at all. But I watched the headlines, right? Taylor Swift's boyfriend plays for the Kansas City Chiefs who won the Super Bowl. Oh, my God, you guys.
You're a full fangirl over there.
Hey,
No. I've never heard a Taylor Swift song in my whole life.
sure.
I haven't, honestly.
I'll be singing it.
But I'm just,
don't
you know,
believe
but I'm just saying that, what's his name?
You've just told us.
It's all good. Look, anyway,
Yeah, get on with it.
back on track. One of the points we did miss last week that I thought is worth a mention, NVIDIA, the market cap 5 years ago was 90 billion. You want to have a guess what it is today, Jacob?
Did you
No.
So you didn't read the documents?
No,
No,
good read.
1.7 trillion.
Beautiful.
So
That's the
NVIDIA,
size of the Australian economy, about the size of the Australian economy.
oh, gross. Yeah, it's worth more than the XLE ETF that we all know and love.
Yes, and have profited from.
So,
Not advice.
so bigger than a combination of all those companies, which is nuts. So it's good value, you reckon?
I think you just answered your own question, didn't you?
That's insanity.
still-
Well, that's pure investor speculation, right? That's investor speculation and bad investor psychology in a nutshell. This is a constant euphoric
Yep.
12 months at NVIDIA, and everyone's going, you know what, this is going to be 2.7 trillion next year.
It's obviously a good company, but
Oh, a brilliant company, no doubt about it. But
Read Robert Schiller's Irrational Exuberance, Chapter 6, if my memory serves me. The New Era Economy. Happens every time. What was it 2 or 3 years ago? What were we all talking about? Brum, 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 brum. Right? Tesla.
electric cars, yep. Tesla.
Right?
lithium was
Last year?
throwing around there.
Last year was lithium.
Yeah.
Right? But lithium was last year because it was connected to electric vehicles.
To be fair, NVIDIA's kind of been hot for years.
Bullshit.
It's not just this year.
No, not just this year. But what I'm saying is, like, it's 1 or 2. What did you say? 90 billion 5 years ago,
Yeah.
right? So that's gone up. What? That's about
17 times, 19 times.
yeah. I mean,
Nuts.
But that's
Time to sell.
that. Well, it's markets, isn't it? That's what we're talking.
Well, it fits in with Wednesdays of last week as well, which is the 200 simple moving average is obviously super useful, but 70% of the S&P stocks are currently trading above the 200-day moving average. 70%.
Yep.
Which is, again, like the higher they go, the harder they usually fall, and that coincides with the cape of the whole US stock market as well. We've talked about for
It's back
for
to
many weeks.
34.
Is it gone up again?
I mean, Jesus, 34, that's twice the average. Now, what does that mean? It means to get back to the average, which if you look at a graph, it always does. The argument is, does it do it in 1 year or in 15? And in the February newsletter, I'm saying it'll be 15. But my point being, well, do you lose money slowly or do you lose money quickly?
Yeah.
Take your pick. But at 34, it doesn't, and like a, I think it
What's
was
that, a compound rate of like 3% over the next decade?
downwards.
Down, yeah.
Yeah. Well, see, I think you were saying before, Jacob, we might have been talking about it during the week, that the point is when it's that expensive, it doesn't mean you can't find good investments. It just means that you need to be really careful with the NVIDIA investment, right? Because everyone's going, NVIDIA's going to take over the world, like idiots 5 years ago were saying, Elon Musk's company is going to be worth like 4 trillion or something. It's like, you dickhead, the whole market's not even worth 4 trillion, right? Like Elon Musk is not going to sell every car in the world. You're an idiot, right? But it's, I hate this because it's that level of analysis where you go, oh, Godfather, these idiots think they haven't even done the sums. You know what I mean? They've just sucked in the story and gone,
must be true.
But it is, isn't it? Right?
Yeah.
That's Nvidia, Tesla,
all the FANG stocks.
all the FANG stocks, the internet stocks in 2000, the Nifty 50 in 1963. All the same idea. What is it? They're all AI is going to take over the world. Nvidia is worth 25 trillion. It's like, oh, okay, righto. It's garbage.
Well, there's going to be a lot of people holding their bags at the end of that disaster, I think. And it's what we're saying, it links into the cliffhanger that we left the listeners on last week around property, but doesn't mean that Nvidia is going to go back to zero. It just means it's going to revert to the average, revert to the mean, become a sustainable price so it can continue its journey.
And it may be a long way lower.
And it could be it could be a long, long way lower, but it doesn't mean you're going to pick it up for $1 again.
Well, that's right. The difference between stocks and property in that sense is stocks are a lot more liquid, and so they can tend to fall a lot faster. There was one I was thinking about. I can't remember what it was, but it fell. You look at WeWork or Zoom or some of those, COVID, lockdown stocks. What's that bike thing? Peloton, right? Some of the gym stuff, right? They've fallen 80 to 90%. It's all over Red Rover, right? What I'm saying is property is different. Property won't do that, but it may do the equivalent.
Just not go any higher for a while.
Sydney might stay at 1.5 million for the next 15 or 20 years. And when you look back, like we talked about in the previous episode, when you look back and go, oh, actually in 20 years, inflation, repayments, actually I haven't made any money.
Yeah, it's just may not be a favourable investment.
Well, that's why, Tom, if you look at the yield now, you can't extrapolate the capital value out, right? So Sydney property is yielding as an investment. I'm not talking about a home, right? But as an investment, it yields about 2, you might get 3. Okay, well, I can get 4 in a bond. Why would I want to invest in 2 in a risky asset with a big capital value where you leverage, or I can take 4% in a bond?
Well, that's the thing, right? Leverage.
Exactly.
It's the...
Yeah, but who wants to borrow $1 million to buy bonds?
Yeah.
Because, bonds don't have a capital growth, mate. And it's like, yeah, but we just proved in the previous episode where we talked about Sydney property from 1980 to 2000, you didn't make any money if you borrowed at 16% to 18%, right? Even though interest rates fell. And that's why I'm saying with stocks and property, you've got to do those figures to go, hang on, this doesn't make sense. But Nvidia doesn't make sense because it's on a PE of about,
60,000.
Yeah, yes, right. But people say, yeah, but Steve, it's going to be twice the size in 10 years. And then when you say, okay, well, run me through that. Oh, because there's this huge AI and, AI growth, blah, blah. I know, but it's like we talked about right at the start of the last episode, right? It's the valuation, right? You can have a really good runway of growth, but what's the price you're paying for the growth? Right? That's the point. And what we know is from cycles, people, extrapolate out into everything's fantastic. It's going to stay fantastic. We haven't built enough houses, we've got a shortage of land planning, like blah, 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 blah. That all makes absolute sense.
Mm-hmm. Well, it's only the people that have bought houses and made a lot of money out of houses that are talking about how great property is. And I think it's important that we do explain, and will make a lot more sense to the subscribers, but the graph we talked about late on the last episode, which was real household disposable income per capita versus real housing prices, we kind of left everyone in a bit of a cliffhanger there.
Yep.
Do we want to just briefly touch on that,
Look, I'll give you the short story. If you borrow money, you have to pay it back, right? You borrow, you earn $1,000 a week. Now, let's say, just for argument's sake, when you look at that income chart, your $1,000, you're going to get a 1% pay rise for the next 20 years, right? And inflation's going to run at 2 or 3%. So in other words, you're going to lose, in real terms, you're going backwards.
Yeah, purchasing power drops.
Right. Now, but you still got your grand, right? And I come along and say, Jacob, I want you to buy a property. You go, Steve, great idea, they're going up. So you buy a property and it takes $150 out of your 1,000. Now you've only got $850 to spend in the economy. Then I come along in 12 months later and I go, Jacob, that place you bought, it's now gone up in value. Why don't you borrow another against that value, which may not stay forever, right? And Jacob goes, yeah, great idea, because I bought a property for $500, now it's worth $650, so I'm going to use the $150, borrow again and buy another property, right? So you buy another property. Now, that costs you $200 a week, right? And we won't worry about negative gearing and stuff. My point being, you get to a point where you go, I come back and go, Jacob, you should buy another property. And you go, Steve, I can't, I'm paying all my income out in debt repayment. So at some point, when you look at that on an aggregate level, you run out of people to lend money to. That's why you find the banks reduce the criteria, right? Because what they do is they go, shit, Jacob hasn't got any more money. Okay, listen, let's go and talk to that bloke, Tom. He's got a few bucks. He might be able to borrow might be able to make a loan. You try and make a loan. Why? Because property's going up and Jacob's making lots of money, right? But then it all stops at some point. And that's why I'm saying it's the same in stocks, right? Everybody margin calls, I shouldn't say everybody, but institutions borrow more and more on margin and it becomes pro-cyclical, right? Which means it magnifies the gains. Great, but Lord help you if you don't get out when the gains start turning into the losses, right? And the underlying belief about property is property always goes up. Well, yeah, that's like saying stocks always go up. The difference is from 2000 to 2023, property's made about 11%, 12% compound in Sydney. Stocks have done nothing. But if you bought stocks in 2009 in the US, you've made about 600%, right? So what I'm saying is it's about timing and the valuations. It's not about saying, stocks go up forever. Well, okay, but they generally make about 2% real over 40 years. What did Sydney property make? About 2 to 3% real, right? So what I'm saying is when you hear those arguments of, stocks just go up so you buy the dip all the time, it's like, okay, but if I retire in 5 years, what happens if my stock values halve? Oh, well, you'll be right, dude. It'll go up over the long term. And it's like, yeah, but I haven't got the long term.
Yep.
Right? And that's why I'm saying with property and income, you've got to look at that because eventually there's no longer people who can borrow. And what that means is the momentum of price stops. Because I look at it and say, geez, I'd love to buy Jacob's property. Oh, I can't because I haven't got any money. So Jacob has got to meet me at a point that says, yeah, well, Jacob, I'm only allowed to borrow 600,000. You want 750, mate, I can't buy it. And Jacob's got to say, okay, well, I hang on to it and I lose money on it on purpose with negative gearing. Or he says, well, okay, well, look, Steve, if you can hit 650, I'll take it. Right? And then the market starts falling. That's how markets operate.
Mm-hmm. And again, we were talking about this not so long ago. This doesn't mean that Sydney, Brisbane, Melbourne property is going to go back to 2000 level at 450,000. It just means that it might stay at 1.3, 1.4, whatever the average is at the minute, for the next 20 years, as then wages rise with inflation to meet the market price.
Well, with the interest rates, compared to the asset prices, it's not a really compelling investment right now.
Exactly.
If capital growth stagnates.
Yeah, but
because that's been the thing.
But even Tom, but that's my point, right? Yeah. Even with capital growth, there are people saying, you got to leverage up and you do this and you do that, and it's all relying on the capital growth.
Yeah.
Right? It's an absolutely stupid strategy on stocks as well, right? Not just property. to lose money on purpose to say, yeah, but I'm gonna get it back in 5 or 10 or 15 or 20 years. Who wants to pay off an asset for 20 years? You've got no idea what's going to happen in the next 20 years. Right, so you imagine we're in Sydney, it's 1980, we've been through this boom we've had for the last 20 years, right, which has been absolutely insane. And then I say to you, yeah, Tom, keep going, you'll be getting 8 or 10 per year, so borrow at 7. Best of luck on that. When we've had, as I said to you guys, we've had a global property boom for the last, in 2000, and I won't bore you with the details, but simply saying, property prices are now making up an enormous 70 to 75% of people's wealth, and it's way out of kilter with history. So if you're going to argue it's different, I'm happy to hear it, but I'm telling you, it's all debt. That's why America's got huge household debts. Australia's got, enormous household debt, right? Why? Because we're all out there speculating on property.
Yeah.
Yeah. Well, there's a huge change of hands in wealth, especially in Australia, going from the old boomers into the younger generations as well. So that what's happening is the younger generation are seeing how much the boomers have made, and they're falling into the same traps almost.
Well, the worst problem I think, Jacob, is, which is sort of will deliver you millennials or your Gen Xers some justice, is the parents are going, oh, well, we've made a shitload. We'll lend you $500 for the deposit. It's like, great, right, Mum and Dad.
Or here's a house.
Well, yeah. But, the kids are going to get it anyway. So my argument is, I know, you younger guys can complain about property prices, but you've only got the shits because you see property is going up.
Yeah. Oh, well, I came up from the UK. I don't have a family that's like, here, mate, you can have $500,000.
Yeah.
Go figure it out yourself, brother.
But you think, Jacob, if I said to you, listen, mate, I want to give you this house. Listen, it's going to halve in value over the next 15 years. You'd go, well, no, I don't want it, right? You wouldn't be going, oh, I'm missing out on property, blah, blah, blah. The complaints are missing out is the complaints of all you old bastards are making lots of money in the capital gain. But the reason why, we made lots of money was because we bought in 2000.
Yeah. Yeah.
Right?
You weren't geniuses.
No, I've admitted this myself, right? I bought 3 to 4 properties in 2000 to 2002 and made really good money. Why? Let me be honest, it wasn't because I was a bloody property guru. It was because at that stage I was about 40. I was earning a 6-figure income. I had no kids. I had heaps of disposable income. And what did I do? Leveraged up.
Yeah.
Right? And that's what I'm saying. That's, you've got to be humble enough to say, do I actually know what I'm doing here, or am I getting lucky? And it's really hard when you're in a bubbly asset market to say to yourself, I'm just being lucky, because you say, oh, well, Jesus, if I don't know what I'm doing, when do I sell? Right? Because you get greedy, right? Oh, well, I'll keep going because you're riding the luck, right? That's the trick.
Yeah. Well, what do we reckon the Aussie market will do over the next 12 months or so? I know there's a pull out for the subscribers. 52% of people think the share market will be up in the next 6 months. 20% will think no change, and 27% expect it to go lower. I think doesn't it just usually map the US market?
I predict it'll either go up or down.
Yeah.
Yeah, I think that's a good prediction. Well, I said my prediction, up 20, down 20. It could be either one or something in between.
And it doesn't matter if you got your strategy the right way.
Well, it's a yeah. I think that's in there because it's a demonstration of recency bias. As I said, if you look at 2023, the Australian market went nowhere between January and November, right? In actual fact, or October, it actually meandered and was down. But then the middle of October, like you said, Jacob, like the US market, it went gangbusters, right? So what do people do now? Oh, man, I think it's going to be fine. Why? Well, it's been going all right for the last 3 months. It's like, okay, that's a good enough reason.
It must be all right, yeah.
Well, like I said, with property prices will rise. Why? Well, they've been going up. And it's the same thing in stocks.
Yeah.
Who cares what's going to happen over 6 months? Are you planning to sell?
Well, no. Well,
okay.
You just move your money around depending on the strategy, right?
Yeah, exactly.
Which it's actually, I was talking to someone last week about asset allocation, and I said, look, too many people think that they want to make $1 million in a month.
Yep.
And an investor cycle is actually as long as you live. If you don't want to work and you want to invest for a living, you're not thinking about one trade. You're thinking about how can I move this money into a better position. And that might be every 6 months, every 12 months, every 2 years, whatever it is. And too many people think about the stock market being a one investment decision, and this Nvidia trade's going to get them up 17x, for example.
Or Bitcoin?
or whatever, insert whatever the next AI, the next thing is.
Yeah.
What we're saying is it's not about that. It's about how do you take the money when the market gives you it and move it into a better position for the next 20 years so you can live the life that you want to live. You know what I mean?
Systematic investing.
It's having a systematic approach and being sensible with it, not about going, okay, I'm going to turn this 100 grand into 500 and see you later, I'll be in the Maldives. It's not about that.
Exactly. But you see, you hear those stories, right? Oh, Jacob bought a property at 16 when he worked at Domino's Pizzas for $4 an hour, and now he's got 32 properties. And it's like, I know, but he's also owes $32 million.
He's leveraged up to it.
Right? But that's what I'm saying. That a lot of the young people, and I will say you guys, not you guys, but a lot of people your age fall into, how do I get rich in one cycle? Right? And I'll tell you how to get rich in one cycle. Wait for the bloody thing to be cheap, right? Because then you'll compound at 10 or 11%. You ain't going to do that when you're getting a yield of 2%, right? That's a PE ratio of 50, right? But it's really hard for young people because you haven't got the knowledge of cycles to say, everybody's making money in property. I just want to buy a property and make money like everybody else. And my argument as an older person is saying, do you know what you're doing? Do you know what the cycle is? Or are you just doing it because the banker said, listen, mate, I'll give you 600 grand. You're young, you're earning 200 grand or whatever. And you go, sounds like a great idea. I'll be rich by the time I'm, 40. Financial independence, retire early, right? Well, take it to the casino. But there's people in stocks and property will say, that's the way you do it, right? Because that's the way they did it. But that doesn't mean you're the next Warren Buffett or you're the next property Nathan Birch guru that's, flogging properties off to people. That's the point.
Yeah. The other thing to note, the US Cape almost at 34.
Bingo.
So anyone who's been listening to the podcast knows that that's a pretty good yardstick that the market's pretty expensive right now.
Absolutely.
Also underscoring the fact that doesn't mean there's not a bunch of great opportunities there, but generally speaking, expecting lower returns, particularly from the headline stocks,
the aggregate
right?
point of view. Yeah.
100%.
Well, that's what history shows us.
Yeah.
So who are we to argue that there's 120 years worth of data? Oh, but it's wrong this time. It's like, okay, but that's what they say every time the Cape hits, 30.
Well, it's just worth, just reminding everyone that if you lose 50%, it's got to go up 100 just to break even.
Yep.
Right.
Let me give you a little sample here, right? People talk about 8% average.
Yeah.
Right? That's the long-term return. Okay. How do we get 8%? Now remember, that's the average over a time frame. Right? So do this for me in your head. You got $100, right? Now it doubles. How much have you got?
200.
Okay. That's the first year. You've made 100%. Okay. Now you got $200, right? Now you lose 84%. How much you got now?
$32.
Right. But what's the average return? Plus 100 minus 84 is what? 16 divided by 2.
8.
But Tom, your average return is 8%. But how much money have you got? $32 out of your original 100.
Gross.
Right? Or there's 100 plus 8% plus 8%. Yeah. Right? Well, there's the average of 8%. But do you see what I'm saying? What I'm saying is the average is a compilation over time, right? So that's why I say to you, in the first case where you went $32, I'm going, Tom, 8%, mate. You're going, Steve, I'm down $75. Yeah. Oh, yeah, but your average is 8%, Tom. That's what I'm talking about, right? That's why compounding is bullshit when people say you get 8 to 10% compound. No, you don't. You get volatility, right? And that's why I'm saying when you look at that, that's the way you work out investment returns, right? And we talk about that in investing essentials or
making sure you got a systematic approach. And as the Cape's rising up to 34 like it is now, like our strategy is moving into one of the more volatile strategies to make money quickly and take money off the table.
Yep.
Which is what we believe is going to be the case over the next 10 years or so.
That's right.
And that's well one. So wealth 3 and well 2 will keep looking after themselves. But we believe that the first one and the more volatile strategy is the way we need to start looking now.
You can make money out of volatility, and the volatility is simply price fluctuations.
Yeah.
Now, if you think prices are going to fluctuate, just for argument's sake, right, between 30 and 70, well, at 70 you'd sell, and at 30 you'd buy. And when you buy at 30 and it goes to 70, you sell. And then it falls back to 30, so you buy again, right? And it goes to 70, and you sell. And it goes back to 30 and you buy at 30. So what I'm saying is you're making money because you're buying at 30 and selling at 70.
But what if you start that process and you buy at 70?
Well, if you buy at 70...
That's the valuation.
The valuation, right? And it goes to 30 and you go, like you said before, Tom, shit, now I've got to make 100% to get back to where I was.
Or you buy some more at 30 and bring your average price down to 45 or something.
Yeah, but that's true. You can do that. And that's how a lot of people survive, by simply feeding money into the market. Now, here's another key point. You can't do that with property. Mm. If you buy a property at $1 million and it falls to 800,000, you can't say to yourself, oh, well, that's all right, I'll rebalance it. You can't do that with property.
I'll sell a couple of doors.
Well, but you see what I mean? They're different investment types. Yeah. You can do that with stocks, and that's one of the arguments I make with stocks, right? If you buy it wrong, you can maybe get out because you can buy more at a lower price, right? Now, it might go bankrupt, absolutely. But if you're using ETFs and you buy the Australian market, for example, Vanguard's Australian shares, VAS, you can average in and out. You can't do that with property. You can't say, my property's gone from 1 million to 1.4, I'm going to sell 2 bedrooms for 400,000, pay down my loan. You can't do that with property. You've got it's a all in or all out. Mm. Right? And it's a different investment dynamic. And I'm actually going to talk about that in a masterclass. But my point being, it's really important, because if you buy stocks markets too high, you can still get out by averaging down. And quite frankly, a lot of people don't realise it. That's what happens in their superannuation. They're just buying over time. They're buying when it's cheap, which makes up for them buying when it's expensive. Yeah. Right? So that's like you were saying about 8%. You buy at 100, it goes to 200, you go, this is great. And then it crashes 84%. But you keep buying at $32. You just keep putting in your $10 a week, right? And eventually you recover. But what you should have done was sold at 200 or 180 or 150 or 170, right? And waited for it to get back to 50, which we know that it does.
Yeah. Yeah, look, the last one, chart of the week, in the week that was, global growth forecast by GDP in 2024. It's not exactly kicking it out the park. Australia at 1.2% below inflation. It actually means that we're going backwards, right?
Yeah. We're going to grow 1.2%.
Yeah.
And inflation's running at about 4%.
Yeah.
So it means we're actually going backwards, right?
We're clawing.
It depends. The big one there is what people do with and this is the one thing to watch. Watch what happens with the tax cuts, right? If people spend the tax cuts, we'll get better growth. Mm-hmm. If they don't spend the tax cuts and they say, listen, we're going to continue to pay down the property loan, then the economy won't improve, because that money is not buying stuff.
Which is likely to happen given the last 12 months.
Well, yeah. I'm agnostic, but what I'm saying to people is watch what happens to that, because that's new money coming into the economy with less tax. How do people spend it, or do they save it? If they save it, the economy's going to struggle. If they spend it, growth may pick up.
Okay, yeah. It's an interesting one. Okay, well, I might talk about that a little bit over the next 12 months as it unfolds.
It's a big one to watch.
For now, one thing I wanted to mention, we've had a changeover at the website. There's actually a personality assessment on the website now as well. So big thing that we believe in is understanding what type of investor you are for your personality. And the assessment is called the Enneagram. You can jump online, it's free, check it out, but it will actually give you a little bit more information on who you actually are and the type of investor that you can be. So jump on that. The website looks cool now. It's got photos of Steve, Tom and I, so we're looking all pretty. And it's
with Reece Walsh and Paddy Carrigan. Photo in the private jet.
Yeah, right.
And by next week, we'll remember who Taylor Swift's boyfriend is.
Yeah, Steve will come with that. But yeah, just a bit of a plug. Jump on, check it out. But for now, we'll leave you there and see you next time.
Thank you.
Cheers, fellas.
See you, folks.
Stay up to date on our socials. Just search for Total Money Management on Instagram and TikTok. For your free investor personality assessment, go to totalmoneymanagement.com.au. And as always, remember, we don't provide financial advice.